Simon Mariner joins us now from St George to tell us more about the economic news around today and, of course, to speak a little bit about the markets. The market today, firstly, sentiment, it looks like we've been getting that from offshore.
Yeah, look, the market ending probably pretty flat today. It's going to end, not just off a little bit. Gold stocks, as you mentioned, were really the big ones of today. But you could argue it sort of held up pretty well given some of the panic selling that we might have seen in stock markets from around the world. The Aussie dollar, very well behaved today, just a 1/4% range, which is pretty untypical. It's been pretty volatile of late. It's currently sitting around 83.5 US cents. Interest rate markets as well. I came in this morning and they were off just slightly, perhaps on the back of some of that risk aversion we saw from offshore markets last night, but they've been steadily just creeping a little bit higher over the course of the day.
Okay, the trade data out today, what did you make of it?
Well, look, the deficit was higher than consensus. It's interesting, a bit of a theme this week of data printing outside of expectations. We had quite a few big swings in some of the more typically volatile components, although some of the traditional components a little bit more well behaved. You know, we saw a little bit of resilience in some of the non-rural components. That's things like metals, metal ores, minerals, that sort of thing. A little bit of a downswing in some of the capital goods imports. You could perhaps argue that business investment could have been brought forward from Q3 to Q2 given some of the stimulus and some of the incentives we've seen. So perhaps that was brought forward a little bit. But also a little bit of an acceleration in consumption good imports, which is perhaps some of the retailers restocking given that sort of consumer spending has been a little bit more resilient than perhaps expected.
But just how significant was all these numbers given the GDP and current account data this week?
Yeah, look, really good question. Two big figures this week. The current account deficit blew out to $13.3 billion, which is the widest it's been in over a year. You know, exports fell. The fall in exports outpacing the fall in imports. You could argue that exports have been hit with a little bit of a double whammy. Commodity prices have come off and the Aussie dollar's looking quite strong, so that makes them relatively less competitive. The GDP data, again, was one of those pieces of data that I mentioned that printed way outside of expectations. We saw a 0.6% growth for the quarter, which was double what we were expecting. You know, perhaps you could argue again, as I said, that some of that growth was brought forward from Q3 to Q2 because of some of the stimulus and some of the incentives we've been seeing. But it does really support the view that the domestic economy is resilient and that perhaps we've skirted some of the worst of the global economic downturn.
And what are the implications for the RBA in terms of interest rates, and when do you now likely see the first hike?
Well, yeah, look, the bias is neutral, but as the market agrees with you that the next move is going to be a hike, so it's, yeah, not so much about what, but more about when. The surprising GDP data, because it was such a big surprise, you could speculate that the RBA is perhaps going to wait a little bit longer than what the market's suggesting. The reason is they might sort of look to see whether there is a bit of a pullback in spending, perhaps a bit of a pullback in growth as some of that stimulus, as some of those government incentives are unwound. So, look, markets are really factoring in strongly for a rate hike October, November this year. You could speculate that perhaps the RBA might wait until November, maybe December, to have a look and see if there is a bit of a pullback in that spending.
Okay, and in terms of what you're looking out for next week, Simon, what are they?
Well, next, I think, on the radar tonight, in fact, in the US, we're going to see initial jobless claims. There's going to be a bit of a, perhaps, I suppose, a comparison and contrast to what we saw in the jobs data earlier this week out of the US. But more importantly, I think investors are going to be looking as to some sort of clue as to what's going to happen with the non-farm payroll figures, which print this Friday night. It's a big figure. If it does print outside of expectations, it does have the ability to move the markets quite a bit. So they're going to be looking at that very closely. Unemployment has been increasing in the US, although the rate at which it's been deteriorating has been decreasing. So that perhaps points to a fact that a bit of a recovery is underway in the US. And employment's very big. It's very important. You know, it drives confidence. It drives consumer spending. You know, housing finance. If people are confident they're going to job next week, next year, etc., it does drive a lot of the other parts of the economy. So a very big figure. Locally, not much to steer the markets really until next week. Next week we'll have a quick look at some confidence data, some retail sales data, and some housing finance data.
Okay, Simon Mariner, St George, appreciate that. Thank you.
No problem.